Welcome back, and thank you so much for joining me in today's video because I want to talk about some leading indicators of home buying demand so we can gauge which direction our US housing market is headed. I'm going to give you an update as well regarding mortgage rates as well because rates just decreased to a 3-month low. The first report I want to share in today's video is actually from the MBA, just posted on November 29th on Wednesday. It says applications overall increased by 0.3% from 1 week ago. This includes applications for home loans to buy houses, but also for refinances as well. This week, of course, includes an adjustment for the observance of the Thanksgiving holiday because this covers the week ended November 24th here. So the refi index decreased by 9% compared to the previous week, but it's down by about 1% from 1 year ago. That, by the way, is not seasonally adjusted. So of course it makes sense. We saw a huge decrease of refis compared to the previous week, which was not the Thanksgiving holiday here. But on a seasonally adjusted basis here, their purchase index, which is a measure of the amount of people submitting loan applications to buy houses, that actually increased by 5% compared to 1 week earlier, but still down by about 19% from 1 year ago. Also, as a note right here, this also marks the 4th consecutive weekly increase in their purchase index due to mortgage rates falling. Despite this rise, though, applications are at the lowest pre-COVID levels since approximately 1995. And actually, let me just share that with you right now. Here's their purchase index going back to, when was this? The early 1990s? Yeah, approximately 1991. As you can see here, a huge increase of people submitting loan applications right before the Great Recession. It peaked really in 2005, and of course, it just fell off the map after that. Or more recently, though, applications were increasing greatly, especially during the 2020 and 2021, and that decreased greatly as rates increase as well. Let me just add rates here. So as you can see right here, let me just look at the past 10 years. So when rates were falling from more or less November 2018 through approximately the end of 2021, of course, their purchase index was increasing greatly. And ever since then, more or less, applications for home loans have been decreasing, even though over the past 4 weeks has been increasing right here. And again, the current levels right now for their index is more or less on par with the lowest levels since 1995 when looking at pre-COVID levels. So even though it has increased, we're still at very low levels. So going back to the MBA's report here, according to Joe Kahn, who's the MBA's vice president and deputy chief economist, he stated the following. Mortgage rates decreased for the 4th time in 5 weeks, with a 30-year fixed rate dipping to 7.37%, according to the MBA, the lowest level in about 10 weeks. Rates have decreased more than 50 basis points over the past 6 weeks, which of course has helped spur demand for home loans by a very small amount. But activity last week was still around 20% lower compared to 1 year ago. The purchase market remains depressed because of the ongoing low supply of existing houses for sale. I would also add to that is that, yes, if we were to have more houses for sale, we probably would see more applications and more home sales. However, I think the low level of applications is due to a lack of housing affordability, due to high home prices, and of course, still high rates. They also say here that refinance activity will remain muted for some time, even with the recent decrease in rates, as many borrowers or many homeowners locked in much lower rates in 2020 and 2021. By the way, the average rate for those 2 years was at 3%. Now rates are over 7% right now. Also, something that just kind of blows my mind here is that out of all the applications for home loans, 30.6% are doing a refinance, even though rates are much higher now compared to 1 year ago. And also the adjustable rate mortgage share, or the ARM share of activity, decreased to 8.1% of total applications. That's higher compared to last year's low at around 3%, but still lower compared to the 12% rate or 12% share we saw sometime last year. And by the way, just for comparison's sake, when looking at applications for home loans to buy new houses, night and day difference here, because that increased by 39.7% from October last year through October this year. A giant increase of applications when people looking to buy a brand new house. That's also according to the MBA posted on November 16th. Now let's talk about rates. According to Investopedia.com, as of today, which is November 29th on Wednesday, the average rate for a 30-year fix with people with great credit was at 7.65%. Something to keep in mind is that the rates, according to Investopedia.com, tend to be a lot higher compared to other sources. So for example, the reason for that is because they look at a wider range of credit scores. They actually look at a range of credit scores in the range of 700 to 760, and also paying no points in order to pay down their rate. Therefore, they're looking at a wider range of people looking to buy houses. And that's one of the reasons why their rate at 7.65% is much higher compared to other sources. By the way, the refinance average is at 8.22%, which is wild given the fact that 31% of people submitting loan applications are doing a refinance, even though the rate is still high right now. Also, according to the Mortgage News Daily, as of today, the average rate for people with great credit, over 740 credit score, is at 7.13%, a giant decrease of 17 basis points compared to Tuesday. This also marks approximately a 3-month low in rates as well. Also for FHA and VA loan, sorry, there's something in the way here. FHA and VA loan is around 6.50%. 1 year ago for a 30-year fix, we were looking at a rate at 6.65%. So rates more or less are about 48 basis points higher compared to 1 year ago. Also at 7.13%. I mean, this is a pretty big decrease compared to the peak, which was right there, October 19th. The average rate was at 8.03%. That was a 23-year high for the average 30-year fix. So right now, rates are about, 90 basis points less than the peak we saw just about 1 month ago. Also at 7.13%, this is actually the lowest rates we've seen going back to September 1st this year. So more or less a 3-month low regarding rates right now. And by the way, one of the reasons why rates have been decreasing over the past 3 months is due to signs that inflation is actually cooling down. About 2 weeks ago, the government announced the CPI, or the Consumer Price Index, regarding inflation numbers for October. And those readings show that inflation slowed down much more compared to the street's estimates. And because, of course, we're seeing these signs of inflation cooling down, the 10-year Treasury yield today fell below 4.3%, the first time since September this year. Let's change gears slightly here and talk about some more early indications of home buying demand. One of the things to look at, which is not a perfect measure of demand, but loosely correlated here, is according to Google Trends. If you guys go to Google Trends, you can search for any term regarding what people are actually searching for, and to see the search history more or less, or the interest over time, I should say, for that search term. So when searching for homes for sale on Google, the index right now is at 62. This is virtually flat compared to 12 months ago when the index was at 63. So more or less the same number of home searches right now compared to 12 months ago. Let's also have a look at the number of real estate showings across North America according to showingtime.com. I actually haven't shared this in a little bit here. So the orange line right here is the number of real estate showings this year. The line just below that is real estate showings last year. So right now, or at least for the 7 days ended November 28th, last year, we're down by 53.8% compared to the first week last year. Now we're down by 44.8% compared to the first week this year. And in fact, when looking at this chart right here, we've been actually down compared to the start of this year. ever since the 7 days ended August 28th this year. This obviously could be due to a lack of houses for sale because historically speaking, we're still down by about 35% from 2019's levels. But also, of course, the lack of housing affordability, of course, is a huge factor as well. Another report I want to share with you guys, just posted yesterday at the time I filmed this video here, is from the National Association of Realtors. They report foot traffic, which is another way of saying that, the number of real estate showings across the United States in correlation with Central Lock, which is a lockbox company. So for example, in my market, if I want to show a house to my clients here in Sacramento, I just open my app on my phone, type in my code, click the lockbox, and then after about 2 seconds, the lockbox opens. I can get the key out of the lockbox, open the house for my clients. And that action is recorded by Central Lock, and they formulate a national report regarding real estate showings. So according to them, for the month of October, real estate showings in the United States are down by 3% year over year. Now, every housing market's different though, right? So 3 of the 4 major US regions saw a decrease in showings compared to 1 year ago. The West down by 11%, the Northeast down by 8%, the Midwest fell by 2%. In contrast, the South increased by 5%. And here's a map showing just that. The West down by 11%, Northeast down by 8%, the South is up, and the Midwest fell just by a little bit. Something worth noting here as well is that the Midwest is actually seeing the biggest increases in prices compared to 1 year ago. So just taking a step back here, you may be asking yourself, how is this decrease in rates down to a 3-month low? How will that affect our housing market? In my personal opinion, we need to be at a much lower level in order to entice homeowners to sell their houses. I'm just pure speculation here. I could be totally wrong. But in my opinion, we would need to see rates at about 5.5 or less in order to entice people to sell their houses if they're not forced to sell their houses. I would imagine that if our labor market starts to show more signs of cracking next year, some people may be in a bind and have to get equity out of their houses, and therefore they're forced to sell their houses. Just yet, we're not seeing that just yet. In order to motivate people to sell their houses, if they don't have to, I would imagine rates would have to decrease much further than they already have right now. On top of that, I also imagine that rates will also have to decrease below 7% in order to get to home buyers really getting off the sidelines to buy houses right now. The reason why I say that is because housing affordability is at very low levels. So for example, according to the National Association of Realtors, just posted on October 19th, they posted that for August, the most recent stats we have from them, that housing affordability dropped to an all-time record low, the lowest levels since the 1980s. This news also corroborates with Black Knight because they posted on November 6th that housing affordability has dropped to the lowest level since 1984. In other words, a 39-year low regarding housing affordability. They say here the last time affordability was this bad was in the 1980s. Back then, rates were in the double digits and the average home was about 3.5 times the median family income. In stark contrast, the price to income ratio is now nearly 6-to-1 compared to 3.5 times back in the 1980s. On top of that, based on my own analysis of the National Association of Realtors data regarding housing affordability, it's actually pretty grim here because when looking at levels compared to August of 2019, compared to August 2023, the most recent stats we have from them, by the way, they'll release, I believe it's September's numbers in mid-December. There's quite a lag in this report here. But in any case, when looking at August this year compared to August of 2019, your average principal and interest payment, that's P&I payment, is an increase of 116% or a giant increase of $1,200 more per month. That's because back in August of 2019, the average P&I payment was approximately $1,000 per month. Now it's at $2,234 per month. So your housing payment increased by 116%, excluding the increase of insurance rates, which of course have increased greatly over the past several years here. But the average housing payment increasing by 116%, whereas incomes only increased by 21%. Not sustainable. And something has got to give, to say the least. So please leave a comment below with your biggest takeaways from today's video. Also, if you guys got any value out of today's video whatsoever, then please hit the like button. I really appreciate that. Of course, I appreciate you. Like and subscribe, and I'll see you in the next video. Have an awesome day.